want to welcome everyone to the December 12th meeting of the Oklahoma City Post-Employment Benefits Trust. First item of business that we have is to approve the minutes from the November 14th meeting.
Move it. Second.
All in favor?
Aye.
Any opposed? Motion passes. Next item is receive the monthly preliminary performance report as of November 30th, 2016, and Doug Anderson is here to present to us.
Thank you, Mr. Chairman and trustees. If you will turn in your packet to the market environment page, just talk about that for a few moments. If you look at the performance chart, the line chart on the upper right-hand side, you can see that there was a distinct happening the early part of last month. And with that, the election, you notice the equities, the solid blue line there, the Russell 1000 large cap was up, but the Russell 2000 small caps was up dramatically, and that did affect the performance of the portfolio. Other things that happened during the month is interest rates. Treasury interest rates started to move higher as many of the policies of the incoming administration were judged to be potentially inflationary and driving interest rates higher. Now, the market has moved rather reflexively, very quickly on all of these matters, and if we take a step back, maybe has gone too far, both on equities and on fixed income. And I was having a discussion with one of my colleagues this morning on the drive over, and our, I guess, contrarian nature comes out during times like this, and when we see prices of equities move higher very quickly on the basis of a presidential election, we're reminded by the fact that the economy makes the president, not the president makes the economy. And that's an apolitical statement, but knowing that even the biggest change at the highest level of the government can't affect the economic behavior of the rest of us in the country, because we do have economic problems. And not only do we have economic problems, but Europe, Asia, et cetera, also are not in the best places. If we look at economic growth this year, probably going to be under 2% real GDP growth. That's not great. And how we're setting up for next year, it could be around there, it could be slightly lower, it could be higher. I think we're really in uncharted territories, and we want to step back and really look at the fundamentals and where there is value to be found in the investment markets. So that is my economic and market pontificating for the month, and if anybody has any questions on that, I can be even more evasive in a moment. The next page shows the preliminary performance report. The market value at the end of November was $41.6 million. The monthly return was 1.82. The quarterly return was slightly negative, 2 basis points negative. The one-year return of 441, the 3-year of 262 annualized, and the 5-year return of 672. Looking down that one-month column, you will notice there are changes in the asset allocation. Recall last time we were together, the investment committee decided to reallocate the fixed income portfolio to have parity between DoubleLine, Loomis Sayles, and Hoisington. We did not change the target allocation of the high-yield bond fund, although that is the best performer for the month. The net effect of that asset allocation change was to take 3% from Loomis Sayles at the total portfolio level and 3% from DoubleLine, that's $1.3 million, and allocate it to Hoisington, who got $2.6 million and promptly showed one of the poorest monthly returns we've seen from them in some time. But just to reiterate, this portfolio is a hedge. It is a hedge to everything else and volatility in the portfolio. Not only that, you can see that it can provide good long-term results. We don't show any of them on this page, but coming into the third quarter of this year, it was the best performer in the entire portfolio for the trailing year. They're investing only in long-term treasury bonds, and their indication on where the market is going right now is that they're not seeing significant economic changes that will be impactful for inflation in the near future. It takes time for legislation to be made, much less for its impact to be felt. However, they do think that the Fed will raise short-term rates this week. That is a near certainty that that will happen. And already the rising interest rates from their perspective has started to slow the economy at borrowings at some levels. If you look at what has happened to the Mortgage Bankers Association. Remember, mortgages is probably the biggest debt that most of us have on our personal balance sheet. Even with the most recent increase in interest rates, Mortgage Bankers Association is expecting refinance applications to be down 50% next year over this year. New mortgage originations down 20% next year over this year. So that is already starting to have a meaningful slowing impact on the economy. Looking down at the rest of the results here, our Vanguard fund was right on the marketplace as we have expected them to be. Dreyfus Appreciation did not perform as well as the market. We'll get back to them in a few moments. You'll see our Vanguard Mid-Cap Index fund there, 5.8% of the portfolio, right on the marketplace. Hotchkiss & Wiley, a very apparent beneficiary of the equity market rally of small caps and also beneficiary of some energy holdings in the portfolio that did extraordinarily well. 14% rate of return for a month. I'm so pleased to see that, knowing that we've been talking about Hotchkiss a lot in the past. And then Stevens, with their very cautious, long-term growth-oriented portfolio, up 6.71%. Again, we still like this firm and their investment approach very much. Causeway is the international equity portfolio, focusing mostly on Europe and higher quality stocks, although some cheaper companies there. Met with Harry Hartford, their chief investment officer, last month here in Oklahoma City. Their portfolio is having a difficult time right now, but it is an area, a time of a lot of flux in the marketplace. Just remember a year ago how much the anxiety du jour was Europe and what was going to happen when the EU was it going to unravel? Was Greece going to go away? Greece never went away. Markets have been tough ever since. Britain did go away from their limited membership to the EU, and it seems like the impact has been much less than the perceived impact of what would have happened if Greece had gone away. So sometimes the reality is much less dangerous than the perception going forward. But they're very cautious long-term investors. They're looking at 4-year earnings growth on their companies to take some of the short-term cyclicality out of their projections. So all in all, a very challenging month for the portfolio. The allocation to Hoisington, I'm much more comfortable giving them money today than I would have been at the lows of the interest rates, 30-year treasuries, earlier this year. If we look at where 30-year treasury rates are today, it's about 3.17. We're not that far from where we were a year ago. It's just this recent change has been pretty fast, very, very quick. So happy to take any questions on this specific monthly report.
With that, I'd have I accept a motion to receive the monthly performance report.
So moved.
All in favor? Aye. Motion passes. Next item is discussion of any recommended changes, and we have a handout that was provided. Does everyone have that? On the front, it says strategic asset allocation, equity portfolio. Got that? Okay. Doug?
Good. Since everybody has this, this is an extension of the discussions that we had last month. We were able to resolve our questions about fixed income and saw what happened, how we reallocated that portfolio to be more evenly weighted between our three core or interest rate anticipating managers. What this is going to address is something that we were not able to resolve in our meeting about the equity portfolio. And the source thumb that we have in the equity portfolio is Dreyfus Appreciation, a portfolio that's managed by Fayez Serafim and Company. They've managed money for literally decades trying to buy the biggest, most stable growth companies in the world, primarily domiciled in the United States. And the portfolio was put in as a way to achieve the upside of the market and have limited downside. And that was the original notion. Sadly, that promise has not been kept, or the idea has not been fulfilled by this portfolio. You'll see on the first page when you open up there, assets under review, conservative large cap growth, equity fund, blue chip companies, strong balance sheets, very diversified operations around the world, and high dividend yields, but with very low volatility. If you look at the characteristics in the table below, you'll notice that there are some inconsistencies. right? We expected this portfolio to have very low volatility, but when we look at the primary measure of volatility, standard deviation, it has not delivered on that. It has had higher standard deviation than the index, and we show the S&P 500 because that's where these assets would most naturally flow to if we were to liquidate the portfolio. You'll see that the standard deviation of gains has been lower, so in up months it has been less volatile, but in down months it's been more volatile. And again, that's something we weren't expecting to see out of this portfolio. Part of it is due to the individual names in the portfolio. They do have some energy concentration higher than the marketplace, and so that's hurt them during the currency or the commodity bear market that ended earlier this year. Some of their technology holdings, Apple, have been more volatile than the marketplace and not been doing quite as well. And you look at these next two characteristics, best quarter and worst quarter. Their best quarter wasn't nearly as good as the S&P 500. They trailed by 175 basis points, but their worst quarter was worse. So we're not getting as much on the upside as we wanted, but we're getting more on the downside, which is exactly what we don't want. And if we look at the rest of these figures here, the up capture and down capture, this is a monthly observation. If the market is up, we average the return of the fund versus the market, and then when the market is down, we take an average of those months as well. And so when the market is up, we're only getting 90% of it, but when the market's down, we're getting almost 120% of the downside. So,
is that measured on a manager? Is that measured from the inception of that fund?
It's month by month, and it goes back as this one goes back, I believe, 5 years on this. So I think it's a very
so it's not back to the
period.
beginning of the fund necessarily, but 5 years back and look at the month-to-month changes.
Right.
Okay.
Right. And again, you know, the last 5 years I think is a really good snapshot. If you go longer than that, then it starts to be, well, the market was different. The people managing the portfolio may have had a different mindset. I think this is it's long enough to be relevant, but it's short enough not to be stale, is one way I like to think about that. So looking at that's how the S&P 500 compares to the Dreyfus appreciation. Now on the following page, the portfolio allocation comparison, there are two tables here. The top one shows the allocations that we considered already, the ones that we talked about, the previous model, option A, option B. And you'll notice that on the we are going to be focusing on option C and option C+. And these are not my math grades from college, but this is, we decided on option C, and you'll see the bond portfolio. We've already executed that plan, that 9, 9, and 9, and 3. But then option C and C+, we were asked to investigate, would it have any meaningful impact if instead of going all passive on the large cap side, if we went down to 10% to Dreyfus appreciation, but the rest we went passive with. And if we look down to options C and C+ on the return comparisons below on the second table there, and you'll see the return for the last 1 year for option C was 5.8, for the option C+, 5.2, 5.5, 5.1, 10.7, and 10.1. So it's been modestly lower. Part of that's due to fees, because these are all net of fees. Part of that is due to the 10% allocation to Dreyfus appreciation. So you have lower fees in C, and you have lower returns coming through that 10% allocation from Phi to Seraphim. Standard deviation, option C is slightly higher, but that's a statistically not significant figure. If we look at the best and the worst, they're still very, very close here, down 26.4, and these are 5-year observation periods too, Mr. Chairman, down 5.3 and down 5.1. So I think that what I took from this was that this is it's a very interesting vehicle. It's a very interesting investment thesis, but it hasn't delivered what we'd expected it to. And not only that, it's given us we spent a lot of time on this that I don't think has been productive for that, although I love talking about this all day long. If we want to really think about making every piece of this portfolio work, it seems like the large cap market is so efficient that it behooves us to put our large cap allocation into an index fund and then focus more on the international and focus more on the small cap and focus more on the mid cap. And that's not to say that we'll have 36% in the Vanguard 500 index fund a year from now. It could be lower than that. We could allocate those assets to more profitable parts of the marketplace. So my recommendation is to first. If there are any questions, take those. But I'm not one to oversimplify things. I'm not one to be overly reductionist on ideas like this. It's just I don't know what we would be getting from a 10% allocation to this fund as far as the promise going forward. And again, we've had this through up markets and we've had it through down markets. And unfortunately, it's disappointed in both up and down markets, which is very difficult to be pleased about.
So,
say again?
Tell me what it would look like if we were happy.
Oh, it would be, we would have more on the upside and we'd have much less on the downside. So if you look at the upside downside capture, it'd be about 120 on the upside and 80% or less on the downside. That I would be incredibly pleased with that. And then we would be having the discussion, well, maybe we should put 10% in the index fund or 0 in the index fund and everything else in here. I think it also goes back, I mean, we have to acknowledge our history here. We've been a little bit cautious on a lot of our investments, especially going back 3 and 5 years coming out of the great market decline. You know, we didn't want to take too much risk in our equities, and I think that's reflected in some of these investments. We don't want to be too risky. We're going to go with very cautious alternatives. And in my mind, you want to be cautious on the risky assets and you want to be a little bit more cautious on risky assets and a little bit more aggressive on less risky or more cautious assets. And this is kind of, this is a very stable part of the portfolio, hopefully, and we went a little bit cautious on it. So that's a very long-winded answer, what makes us happy.
and already we have decided, just based on recommendations from the last meeting after investment committee, that everything that's on the right side, on the top graph, or the top chart, everything that's on the right side that was on the fixed assets,
Correct.
we've already implemented that.
Correct. Correct. November 17, that happened.
So now we're looking at just on the equity side, and really all we're focused on, because everything's the same between C and C plus, is we've narrowed our focus down to looking at those two options, and it's a question of whether we leave anything in Dreyfus.
Correct.
And then your recommendation was that we go with the C, which was move it out of Dreyfus and everything into the index fund.
That is correct.
Okay. So are there any other questions from that?
I just had one clarifying question. Doug, on the index funds, is the recommendation because our active managers are having a little bit of difficulty and the index funds are performing fairly well?
Ooh, I can think of questions that could be deeper than that and more complicated than that, but not many. One of the things that we look at a lot is, okay, active versus passive management. I mean, because if we're going to be laying out money to pay active managers, we want to be compensated for it. If we look back the last 3 years, it's been absolutely negative, completely negative. And if we think about the reasons why that might be, indiscriminate buying in the marketplace, a lot of people going into index funds, a lot of money flowing to the equity markets. Why? Because bond yields are so low, and it's the only place that you can go to make any money. And that has produced a market that has very high correlation between all stocks, right? So all stocks have been moving up, at the same time, moving down at the same time, no matter what their industry. That's generally speaking, statistically speaking. Now, before the election, that was absolutely what was observable. In the month since the election has changed, that has changed dramatically. So in my mind, this is not an active versus passive decision, in the sense that in large cap, it's always going to be very difficult to outperform the index. It's so cheap. It is set to outperform. It's almost like I don't want to say it's a rigged game, but to beat that benchmark, you have to be really fortunate in your timing and your selections, because the way the index is calculated, the better the companies perform, the bigger the weight they have in the index, the bigger the weight they have in the index, the more it affects performance. And the lower or the poorer the performance of the individual holdings in the index, the less important and the less contribution they have to total return. So the winners dominate, the losers go away effectively, statistically. And it's all done based on who's buying what in the marketplace. And in the large cap part of the market, it's real tough to outperform that.
Thank you.
You're welcome.
All right, are there any other questions? Then I would accept a motion on this. Move based on the investment manager's consultant's recommendation.
Moving that we approve the investment consultant's recommendation for option C.
Okay. You good with that? All right, so we have a motion and a second. All in favor? Any opposed? Motion passes. Thank you, Doug.
Thank
I think
you.
we have one more item, so that was item 4. Item 5 is approving a recommendation from the investment manager regarding the trust's investment policy, and that item is in our packet also. Doug?
Bob, did you want to talk to this? You wrote the summary. I'm happy to do it. Okay. If you'll open your book to the page that says memorandum on it, Bob did a fantastic job of summarizing everything that we discussed in investment policy. We changed the asset allocation. There's a table of target asset allocation within the investment policy statement. We realized that once we had initiated the asset allocation last month, the new change, that we wanted to reflect that in the investment policy, and there is a variance in the investment policy that allows us to invest portfolio in the new fixed income structure during the middle of the month. But if you look at the background here, this memorandum summarizes the changes that we would like to effect in the investment policy statement, and it's the bullet points and the adjustments. It says in the memo here, the paragraph, serve to increase the allocation to active duration fixed to accommodate the change to allocate 9% of the portfolio to the Wasatch Hoisington Fund. Bullet points show what happened here. Decrease the minimum allocation to core fixed to 15 from 24. That's part of the ranges in the portfolio. Minimum allocation of active duration goes from 0 to 7. The decrease in the target allocation from 30 to 18. Remember, because we consider active duration not part of the core portfolio. Target allocation from 0 to 9% there. Target allocation from 0 to 3% for high yield fixed income, because that helps the table calculate out properly. And increase the maximum allocation from 10% to 11% for active duration fixed. One thing I'd like to mention here is that if you look at these, there are 3 of these items, these bullet points here, that pertain only to the active duration fixed. The one that sets the target at 9, the one that sets the minimum at 7, and sets the maximum at 11%. Those are fairly narrow bands, and we did that on purpose. We want to make sure we take profits from this portfolio probably quicker than we would from others, and we want to allocate to it probably quicker than we would on the others on the weakness of the portfolio, because this is a relatively high volatility asset class, and we'll have the opportunity hopefully to do both more than we would on the other asset classes. So that's risk control of our risk control portfolio. And you'll see the investment policy is included, the red line version, and the change in the table is on page 8. Is it red? Yeah,
yes.
It is red line. And very modest changes here.
Just a couple quick comments. Like Doug said, the changes that we're proposing today are on page 8. Those are the only changes that we're proposing today. Normally, if we go through the investment policy and make a significant amount of changes, which we do periodically just to bring it up to date, clarify, that sort of thing, we will usually meet with the investment committee first. Because this was such a straightforward change just to the allocation, we thought it would be okay just go ahead and bring it directly to you as the board to make just this change to the investment policy. As Doug mentioned, it brings us back into alignment with the way that we actually have the allocation structured within the portfolio as of today.
Well, when will we be looking at the policy again?
We're required to look at that annually, so we'll be looking at that again probably in the next few months. And at that point in time, we'll arrange an investment committee meeting and go over, of course, we'll coordinate with Doug like we usually do and get his comments, suggestions on changes Internally, we'll do that also, and we would bring all those back to the investment committee.
Great, thank you.
You're welcome.
Thank you, Doug. Are there any questions on the changes to the policy? Then I would accept a motion to approve the policy changes. All in favor? Any opposed? Motion passes. Next item is to accept the annual financial report for 6/30/2016. And Jake Siebenaller with Accounting Services is here to present the information for us.
Good morning. Just like to highlight a couple items. Inside your packet, you should have an audited copy of our FY16 financial report. Those went out, I think, the end of November, so you should have a copy of that. Like I said, I'd just like to highlight a couple things. The audit this year was completed by AGH CPAs and advisors out of Wichita, Kansas. They also did our comprehensive annual financial report, and I just want to highlight a couple of their opinions. In the auditor's opinion, the financial statements referred to above present fairly in all material respects the respective financial position of the trust as of June 30th, 2016, and the changes in this financial position for the years that ended in accordance with accounting principles generally accepted in the United States. An unmodified, clean opinion was issued. So we didn't have any issues with our financials. They agreed with everything we presented.
So there were no findings?
No findings, no issues.
Material weakness findings or significant deficiencies?
None at all. Everything was
So it's a clean
according
audit.
to bill.
Great.
Within the audited financials, you'll also find the required supplementary information, including a schedule of funding progress, schedule of employer contributions, and notes to the required supplementary information. The actuarial report was also included at the end. It's just some information that we received. Along with the audited opinion, the auditors enclosed an independent auditor's report on internal control over financial reporting and on compliance and other matters based on an audit of financial statements performed in accordance with governmental accounting standards. The results of these tests disclose no instances of noncompliance or other matters that are required to be reported under the government auditing standards. As published, the audited report for the trust net position for the fiscal year ended June 30th was $42.23 million. This is an increase of $3.29 million over fiscal year ended June 30th of 2015, when the net position was $38.94 million. So overall, the financial position for the trust did improve during the fiscal year.
So is page 4 the best place to look at for us on that, just to stay with you?
Yeah, page 4 is
Just an overall summary?
Yeah, that's where it lines it all out. Yeah, page 3 starts just basic the MD&A statement. Just gives you some high-level overall statements. Page 4 is where we start to give more detail and kind of provide reasons and explanations for everything for it going there.
Thank you.
So, are there any questions that you guys have over this at this time?
When we get these reports and we provide them to council, it's just got so much information. It's
Yes, there's
presented from
quite a bit.
an accounting perspective that sometimes those of us that aren't accountants may struggle with trying to interpret that.
Yes.
One good area to go to usually is the management discussion analysis that's on page 3 there, that just kind of gives you a highlight of the different things that changed. And then that summary that's there on page 4 is a good place to be able to review some of the details that are included. And then it just gets into greater detail as you go further back. But I would say that, I appreciate Jake and his leadership on this and helping us with this one as well as with other pension statements that we do. But if you have any questions along the way when you're going through this, if something comes up and you're looking and saying, well, why did this particular number go down? And give us a call. We'll take a look at it and get an answer back to you and just make sure you have the information that you need. Overall, I think it's a positive that our net position continued to increase, but we all know that we're facing challenges with increasing costs in our health benefits, for all, for actives as well as retirees, but especially in the retiree group. So there are a lot of challenges that are there that will probably put some pressure on our financial statements in the future, and so it's just something for us to be aware of. But if you do look through this and have any questions, we'd be happy to provide any response that you need on that. Thank you, Jake.
Thank you.
So I'd accept a motion to receive the financial statements from June 30, 2016. All in favor? Any opposed? Motion passes. The next item is to receive the schedule of regular meetings for calendar year 2017. Are there any questions on that item? Bob, you have something?
Just a quick reminder, we did discuss within the committee about changing the monthly meetings to 10 o'clock versus 10:30, and it's effectuated in this schedule.
Thank you for pointing that out. That's a good point. Are there any questions? I'd accept a motion to approve the regular meeting calendar for 2017. Move it. All in favor? Aye. Any opposed? Motion passes. Next item is to ratify the claims listing. Move it. All in favor? Aye. Any opposed? Motion passes. Is there any business from the board members? Any other items from the board members? Anything from staff? All right, great. With that, we are adjourned at 11:01.